Hello everyone, welcome to the weekly lecture videos once again. And this is the second video of chapter 12. And in this video, I'm going to talk about cost of debt and preferred shares. As you know that in the last video, we talked about cost of equity. In addition to ordinary equity, firms also use debt and to a lesser degree preferred shares to finance their investment. So as we will be discussing next, to calculate the overall cost of capital of a firm, we need to calculate the cost of these individual component. So we already learned about cost of equity. So we also need to know how to calculate cost of debt and cost of preferred shares. So first of all, cost of debt. Look, cost of debt is the return that the firm's creditors demand on new borrowing. Okay. In principle, we could determine the beta of the firm's debt and then use the SML to estimate the required return on debt, just as we estimate the required return on equity. Okay. This is not really necessary. However, unlike a firm's cost of equity, its cost of debt can normally be observed either directly or indirectly, because the cost of debt is simply the interest rate the firm must pay on new borrowing. And we can observe interest rates in the financial markets. Okay, so the simple point I'm trying to say that when a company issues equity, and there is no observed required rate of return for shareholders, right? Whereas when a company issues debt, there is typically an interest rate associated with that. Okay, that may not necessarily be the required rate of return, but there is a basis to calculate the cost of debt. Okay. Now, if we knew that a firm's bonds were rated, for example, say AA or AAA, we could simply find out what the interest rate on newly issued AA rated bonds. Either way, there is no need to accurately estimate a beta for the debt, since we can directly observe the rate we want to know. There is one thing to be careful about, though. The coupon rate on the firm's outstanding debt is irrelevant here. Okay, so that just tells us roughly what the firm's cost of debt was back when the bonds were issued. Now, what the cost of debt today, not what the cost of debt today. So this is why we have to look at yield on debt in today's marketplace, where the cost of debt or the interest rate associated with the debt could be a basis. So look at this example. Suppose the General Tool Company issued a 30-year 7% bond 8 years ago. So the bond maturity is 30 year, the coupon rate is 7%. The bond is currently selling at 96% of its $1,000 face value, which is 906. Okay, so the maturity value is $1,000 and the current price is 960. So to find out the cost of to calculate YTM. Okay, so to calculate this YTM, we essentially need to solve an equation. Probably you can remember that value of a bond at any point in time. So current price is 960, should be the present value of the coupons, right? Present value of the coupons, and coupon is calculated as 7% on the bond maturity value and the present value of the maturity value, which is $1,000. And now to calculate this present value, you need a rate, which is an YTM. So that's essentially we need to find out. So there is no straightforward formula to calculate this YTM that makes the present value of the cash inflows equal to the current price. So we need to do a trial and error method that we have learned in one of the previous chapters when we learned how to find out the value of a debt. Okay, so we essentially need to use a higher rate, compare the present value of the cash flows with the current price, then we use a lower rate, and we keep doing that until the present value of the inflows is equal to the current price. And the rate that makes these two equals is our YTM. And in this case, you see that it is 7.37%. The next is the cost of preference share. Determining the cost of preference shares is quite straightforward. Okay, why? Because preference shares normally have a fixed dividend paid every period and in the perpetuity. That's why preference share essentially is a perpetuity. Okay, so you know that required rate of return or the cost of preference share should be the dividend divided by the P0. Okay, P0 is the current price. So this is the a straightforward way to calculate the cost of preference shares. So look at this example. The Whitefield Limited has a preference share issue that trades on the ASX. The face value of the issue is 100, pays a dividend of 7% annually per share. In March 2019, this preference share was selling at 103. What was the cost of preference shares? Okay, so cost of preference share is, you see, $7, which is the dividend, and divided by P0, which is the current price, 103. So 6.8%. So once again, look, 6.8%, that's the cost of preference share. It means that the investors are requiring 6.8% return for investing in this preference share. Or from the company point of view, the cost of the fund the company has raised by issuing this preferred stock is 6.8%. Okay, so this is the end of our discussion on cost of debt and cost of preference share. And in the next video, we will be talking about the overall cost of capital. Thank you very much.